The financial calendar has circled a specific horizon in early 2026, marking the inevitable collision course of global sovereign debt and desperate monetary intervention. While the public remains distracted by political theater, the central banking cartel has quietly initiated the largest coordinated liquidity injection since the pandemic crisis. This is not merely a localized market correction, but a synchronized monetary flood orchestrated simultaneously by the People's Bank of China and the Federal Reserve. To understand the magnitude of this endgame, we must look back to September 24th, when the Chinese government finally capitulated to economic deflation. After months of withholding support, Beijing unleashed a monetary bazooka, announcing a stimulus package valued at roughly 3.3 trillion yuan to stop the bleeding. This injection represents the most aggressive intervention since the 2008 financial crisis, signaling a complete abandonment of their previous fiscal austerity measures. However, unlike previous cycles where capital flowed into empty apartment blocks, this new liquidity is being strategically directed into vastly different asset classes. The Chinese authorities have explicitly pivoted away from the toxic real estate sector, aiming instead to corner the market on essential hard commodities. This capital rotation is already sending shockwaves through the global futures markets as billions of yuan chase finite supplies of copper, gold, and silver. Simultaneously, across the Pacific, the Federal Reserve has executed its own pivot, cutting rates by 50 basis points despite lingering inflationary pressures. This dual action creates a perfect storm where the two largest economies in the world are debasing their currencies in lockstep to float asset prices. The immediate reaction in the Chinese stock market was violent, with indices ripping higher as short sellers were annihilated by the sudden wall of cash. Global liquidity is now surging through the financial plumbing, seeking a home in assets that cannot be printed by central bank decrees or algorithms. We are witnessing the early stages of a crack-up boom, where the value of fiat currency collapses against the value of tangible industrial resources. The correlation between global liquidity expansion and commodity prices is historically absolute, and the dam holding back these prices has just been detonated. This is the mechanism that creates the everything bubble, lifting all boats temporarily before the reality of currency destruction sets in for the consumer. Smart money is already positioning itself ahead of the crowd, recognizing that the 2026 timeframe aligns with critical cyclical turning points in economic history. The sheer volume of currency being created guarantees that the nominal price of scarce assets must rise to reflect the increased supply of paper money. But within this broad commodity rally, there is one specific metal that possesses a tortured market pathology unlike any other asset on Earth. Before we examine that specific opportunity, we must analyze why China's new strategy creates a unique mathematical impossibility for the Western banking system. The Western financial system, particularly the bullion banks in London and New York, has built a castle on a foundation of sand. Central to this vulnerability is a massive, concentrated short position in silver that exists almost entirely in the derivatives market. Estimates suggest this short position has ballooned to nearly 4.4 billion ounces, a volume that defies physical reality. To put that number into perspective, it represents roughly 5 to 6 years of total global mining production. These banks have sold silver that does not exist, promising delivery on a timeline that geology simply cannot support. For decades, this paper-silver market has allowed institutional players to dictate the global price, suppressing it far below its true value. The mechanism is simple: flood the market with digital contracts to absorb demand, preventing the price from reflecting actual physical scarcity. This has created a bifurcated reality where the screen price you see on CNBC has divorced itself from the street price required to secure actual metal. But China's strategic pivot creates an existential threat to this paper manipulation scheme. The Chinese stimulus is not buying futures contracts on the COMEX, it is draining physical 1,000-ounce bars from global vaults. As physical inventory moves east, the leverage ratio of the Western banks, the amount of paper claims for every ounce of gold or silver, skyrockets. We are already seeing the warning signs in the spread between the Shanghai Gold Exchange and Western spot prices. But the most terrifying signal for the banking cartel is the emergence of backwardation in the silver futures curves. Backwardation occurs when the spot price for immediate delivery trades higher than the futures price, a rare anomaly in healthy markets. It signals acute physical shortage, indicating that traders are willing to pay a premium to get the metal now rather than wait. This financial pathology is colliding with a secular boom in industrial demand, driven by the green energy transition. Solar panels, electric vehicles, and high-end electronics are consuming silver at a rate that mining supply cannot match. Unlike gold, which is hoarded, silver is consumed, disappearing into landfills and industrial applications, further tightening the float. The market is now a compressed spring, held down by naked shorts, while physical demand rips the inventory away. This setup mirrors the conditions predicted by the Benner cycle, a 150-year-old market theory that points directly to 2026. The Benner cycle is not mere superstition. It is a rhythmic map of human fear and greed that has held true for over a century. It accurately predicted the panic of 1991, the dot-com top of 2000, and the financial crash of 2008 with eerie precision. Now, this cycle aligns perfectly with the 2026 liquidity peak, signaling a commodity supercycle top that history suggests is inevitable. But charts are only the roadmap. The engine driving this specific move is a historic and widening supply deficit. For the fourth consecutive year, the world is consuming significantly more silver than miners can dig out of the ground. This is the Silver Institute's nightmare scenario, a structural deficit that has relentlessly drained above-ground stockpiles. Unlike gold, which is price-sensitive, industrial silver demand is dangerously price inelastic. Tech giants and solar manufacturers need silver to function. They will pay $50, $100, or $500 an ounce because they have no choice. In an iPhone or a Tesla, the cost of silver is negligible relative to the total unit, meaning buyers won't stop buying just because prices spike. Meanwhile, mine supply is stagnant, hamstrung by decades of underinvestment and declining ore grades globally. You cannot simply flip a switch to open a new mine. It takes 10 years of permitting and construction to bring new supply online. We are facing a classic economic collision, completely inelastic supply meeting completely inelastic demand. When these two unyielding forces meet, the only variable that can adjust to clear the market is price. And that adjustment won't be linear or gradual, it will be vertical, a true price reset event. The bullion banks are painfully aware of this math, which explains their frantic algorithmic attempts to cap the price at critical resistance levels. They're fighting a desperate holding action, trying to unwind their massive short positions before the dam finally breaks. But China's aggressive accumulation is removing their exit ramp, buying the very dips the banks are creating. When the vaults in London and New York finally admit they are legally empty, the force majeure clauses will be triggered. This means contract holders will be paid out in depreciating paper currency, not the metal they thought they owned. This is the moment when the paper price becomes irrelevant, and the real physical price goes to no offer, unavailable at any price. The divergence between paper contracts and physical reality marks the death knell for the current Western pricing mechanism. For 50 years, London and New York have set the price of commodities they consume but no longer produce. That era is abruptly ending as the Shanghai Gold Exchange begins to assert dominance over the fading influence of the COMEX. This is not merely an economic competition, it is a hostile takeover of the global collateral system by the East. When China enters the market, they do not buy on margin, they take immediate delivery, permanently removing collateral from Western vaults. This relentless drainage sucks the liquidity from the bullion banks, leaving them dangerously exposed to a catastrophic margin call. We are watching a slow-motion bank run, but instead of demanding cash, the depositors are demanding bars of silver and gold. The ultimate irony is that Western central banks are now trapped by their own aggressive interest rate policies. They cannot print metal, and they cannot raise rates high enough to defend the dollar without crushing their own sovereign debt. This creates the ultimate Fed pivot trap. They must eventually print to save the government, thereby sacrificing the currency's purchasing power. As the dollar inevitably dilutes, the nominal price of everything tangible, real estate, oil, gold, and silver, must reprice violently upward. However, silver offers a unique leverage factor that gold does not, specifically due to its dual role as both money and industry. Historically, when the gold-to-silver ratio begins to compress from these extreme levels, it does so with explosive, vertical violence. Currently sitting near historical highs, a simple reversion to the mean implies a silver price multiple times higher than today's value. This is not idle speculation, it is simply the mathematical unwinding of a ratio that has been artificially suppressed for decades. The smart money, family offices, and sovereign wealth funds are quietly positioning themselves for this exact mean reversion event. They view the 2026 horizon not as a systemic risk, but as the inevitable window of asymmetric opportunity. The silver squeeze is no longer just a Reddit meme, it has evolved into a structural geopolitical strategy. It represents the weakest link in the chain of Western financial dominance, a vulnerability that is now being exploited. If that specific link snaps, the resulting volatility will unleash the greatest transfer of wealth seen in a generation. This transfer is not hypothetical, it is the historical consequence of every fiat currency collapse recorded since the Roman Empire. As inflation expectations become unanchored, the psychology of the masses shifts violently from speculative greed to sheer preservation panic. People will not be buying silver to make a profit, they will be buying it to preserve what remains of their life's labor. This wave of desperate capital will crash into a physical market that has already been hollowed out by industry and Eastern accumulation. Expect to see trading halts, limit-up days, and exchanges simply refusing to open as the price discovery mechanism breaks completely. The buy button on your digital brokerage app will likely gray out, a phenomenon we have seen in other squeezed assets. We are approaching the unobtainium phase, where the quoted price of the metal becomes secondary to its actual physical availability. Financial theorists call this Ixter's pyramid, an inverted hierarchy of risk where capital flees downward to the safest, narrowest base. At the top are quadrillions in derivatives and sovereign debt. At the bottom is a tiny, finite foundation of gold and silver. When the massive ocean of liquidity at the top tries to squeeze into the microscopic tip at the bottom, the pressure becomes infinite. The silver market is so geographically small that a mere fraction of global pension funds entering it would double the price overnight. China understands this inverted pyramid, which is why they are front-running the inevitable flight to safety before the West wakes up. While Western media debates interest rate basis points, the East is securing the physical collateral of the next global financial system. The narrative will flip instantly. Silver will go from being ignored to being declared a strategic national security asset by panicked governments. We may see authorities attempt to discourage hoarding, impose windfall taxes, or nationalize mines as the strategic importance becomes undeniable. History is replete with precedents, from the U.S. confiscation of gold in 1933 to the Hunt brothers' squeeze in 1980. But the velocity of the 2026 crisis will be accelerated by algorithmic trading and the instantaneous flow of global digital information. There is no safe harbor in other fiat currencies. The euro, the yen, and the dollar are all burning in the same fire. This leaves tangible assets as the only neutral reserve that carries no counterparty risk and cannot be debased by decree. The window to acquire this insurance at current valuations is rapidly closing as we approach the convergence point of the Benner cycle. The illusion of financial stability is maintained only by the public's continued faith in a system that is mathematically broken. But as China accelerates its decoupling from the dollar, that faith is being tested by the hard reality of resource scarcity. Wealth in this coming paradigm will not be destroyed, but it will be transferred on a massive scale. It will flow from those holding unbacked paper promises to those holding the physical collateral that underpins the global economy. The silver squeeze is not merely a speculative trade, it is a vote of no confidence in the management of Western fiat currencies. When the music finally stops in 2026, the central banks will be left holding their own debt, while the chairs are occupied by hard assets. You do not want to be the one explaining to your future self why you held depreciating currency during the greatest commodity boom in history. The premiums on physical metal will detach completely from the spot price, making acquisition nearly impossible for the hesitant retail investor. We are already seeing the precursors: delivery delays, mint rationing, and the quiet accumulation by the smart money elite. This is the asymmetry of a lifetime: limited downside risk in a tangible asset versus unbounded upside potential in a currency collapse. The trigger event has been pulled by the box stimulus. The bullet is traveling towards the heart of the short position. Do not wait for the mainstream financial news to announce the crisis. By the time they do, the vaults will be closed. Your protection lies in the ounces you hold in your possession, not the digits flickering on a banking screen. The complex derivatives and algorithms of Wall Street cannot print a single ounce of silver, copper, or gold. Real things matter again, and the market is about to teach the world a painful lesson in the difference between price and value. The Benner cycle warned us, the supply deficit warned us, and now the central banks are showing us their hand. Ignore the daily noise of the stock market and focus entirely on the accumulation of strategic physical reserves. The endgame is no longer a distant prediction, it is a current event unfolding in real time across global exchanges. History will remember 2026 as the year the paper facade crumbled and the true price of reality was finally discovered. Make sure that when the dust settles, you are standing on the right side of this historic wealth transfer.